Hello, my name is Tim Newell, Managing Director and one of the Senior Portfolio Managers here at Harvest Investment Services. Many of our AlphaSolutions models are rules-based tactical models that have proven out performance in both up markets and in down. Today, we are going to look at our AlphaSolutions sector rotation strategy to better understand how we use rules-based models with downside risk controls built into the models. The S&P 500, which is 500 of the largest companies in the United States, has 10 different sectors that it gives exposure to. So in other words, each and every stock that is in the S&P 500 would fall into one of the 10 sectors of the S&P. For example, Apple would fall into the technology sector, ExxonMobil would fall into the energy sector, Verizon would fall into the telecommunications sector, etc. What we do with the AlphaSolutions sector rotation strategy is each and every month we analyze all 10 sectors of the S&P. And the 4 of the 10 sectors that are delivering the greatest performance, the sectors that are giving us the greatest momentum, are positioned into the portfolio. So in other words, if there is a sector that is underperforming, we would sell that sector and replace it with a new sector that moved into the top 4 performing sectors of the S&P. So the best way for us to understand how the sector rotation strategy works is for us to look at a given year. Let's start by looking here at 2010. As you can see on this chart, in January of 2010, the 4 top performing sectors that we would have invested in were technology, telecommunications, industrials, and healthcare. We were in these top 4 sectors not because we were projecting or forecasting that these would be the best sectors to be in. We were in these sectors because the rules of the model look at the performance for the previous month and position into the top 4 performing sectors. We would utilize up to 4 exchange-traded funds, also known as ETFs, that were delivering the greatest performance or delivering the greatest momentum each and every month. And then every month we would rotate out of and back into the top 4 performing sectors of the S&P using these ETFs. We get to the end of May of 2010 and now all 10 sectors of the S&P are underperforming. They're all going negative. So for the month of June in 2010, we did not invest in any of the sectors, but instead we reallocated to cash or money market because cash was ranked higher than that of all 10 sectors of the S&P. We get to the end of the month of June and all 10 sectors of the S&P are still underperforming or what we consider to be trended out. So for the third quarter of 2010, the rules of the model called for us to be in bonds because all 10 sectors of the S&P were underperforming. By the end of the third quarter, markets started to turn. And once again, we had 4 sectors that were trended in and were delivering positive performance. So the 4 sectors that we invested in for the month of October would have been basic materials, telecommunications, utilities, and consumer cyclicals. We continued the rotation strategy throughout the fourth quarter because markets remained trended in. If we look at 2011, you can see that we continued the sector rotation, being invested 25% in each of the top 4 performing sectors each month. Markets remained trended in through the first half of 2011. However, when we get to the end of the month of June, we find that all 10 sectors of the S&P were once again trended out and delivering negative performance. So the rules of the model called for us to be in bonds throughout the full third quarter and even through the fourth quarter. All 10 sectors of the S&P remained trended out, as did the broad market for the full second half of the year. So here you can see during these 2 calendar years, not only the momentum participation of the sectors that are delivering the greatest performance in any given month during bull market periods where markets are trended in, but you can also see how we have downside risk controls built into the rules of this model that move us to cash or to bonds during bear markets or declining market periods. Well, at this point you may be saying, well, this rules-based approach sounds interesting, but does it really work? Let's take a look at the performance page of our fact sheet to explore the answer to that question. So as you can see, the top of this chart illustrates the performance of this model, which has dramatically outperformed the S&P over the long-term time horizon. If you look at the year-by-year historic returns, you'll see there are a number of years that the rules of the model delivered significant outperformance over the S&P, such as here in 2011. But you can also see there are years where the downside risk controls caused the model to underperform the S&P, such as here in 2012. It's important to note that this model is not dependent upon our ability to predict or forecast the broad market or the individual sectors of the market. This model is based purely upon the rules of the model and the downside risk controls that are built into those rules to help us to avoid those major market declines that markets will inevitably go through, such as the two major declines that the market has seen in excess of 50% since the year 2000. Which brings us to one of the final points we'd like to cover as it relates to this sector rotation strategy. So one of the ways that we can measure risk in an investment is looking at the beta rating. The S&P 500 has a beta rating of 1.00. So any time an investment has a beta rating greater than 1.00, we would say that the risk of that investment is actually greater than the S&P. For example, if I have a mutual fund that has a beta rating of 1.2, that would mean that I have a fund that's taking on 20% greater risk than that of the broad market. Or if I have a mutual fund that has a beta rating of 1.5, I'm taking on 50% greater risk than the broad market. Is it reasonable to assume that if I'm using a mutual fund or an investment that has a much greater risk, a higher beta rating than that of the broad market, that I should be able to get a higher return? It sounds reasonable. And yet, sadly enough, most investments that have a higher beta rating than the broad market significantly trail the returns of the broad market, even though they're taking on much higher risk. In the sector rotation model, we have a beta rating or a risk rating that is much less than that of the broad market. In fact, the current beta rating of the sector rotation strategy, as you can see in the fact sheet, is less than a third of that of the broad market. So in other words, this model is only taking on about 30% of the risk of the broad market. And yet, this rules-based sector rotation strategy has significantly outperformed the performance of the S&P over the long haul. The bottom section of this chart illustrates the max drawdown, or the downside volatility, where the markets fell approximately 55% from the fall of 2007 to the spring of 2009. On this chart, you have the max drawdown of the S&P depicted in dark gray, as compared to the max drawdown of this sector rotation model illustrated in blue. When you see the vast difference between the drawdown or the losses that the typical buy and hold investor experienced compared to the minimal losses of the sector rotation strategy, you should be able to draw the conclusion that there's a better way than the buy and hold approach that's been used in your portfolio up till now. Hopefully this helps you to better understand our AlphaSolutions sector rotation strategy. For more information on this sector rotation strategy or any of our other AlphaSolutions models, you can view the fact sheets on our website or speak to your investment advisor about how this model or any other models could fit into your overall investment portfolio. Thank you.